Buddy, Eurodollar University. We decided to do a live stream because we got some updated information from the New York Federal Reserve on repo fails. There is a story building in the collateral part of the system that repo fails seem to be in the middle of it. And it ties together a couple of big picture as well as small picture things. Not only do we have implications as far as collateral shortages and collateral conditions overall, we see that in repo fails, that's the direct tie-in. But more than that, we're also bringing in the yen carry trade, Japanese financials, the real yen carry trade, not what you hear about in the financial media. And behind all of that, what's really driving this, or what appears to be driving it, is U.S. recession risk. Well, everybody is taking a step back off the recession cliff, especially after the September payroll report, and even to an extent today's CPI, focused on mostly the Federal Reserve and their reaction to the data and everything else. In the system itself, in the financial markets, there's a very different story. It's not about payroll reports. It's about perceived risk and taking proactive steps to manage them. And that's what the data is telling us, is that what erupted in early August hasn't gone away. Well, it's gone off the front pages and stock markets have zoomed ahead and we even got record highs again. In the background, in the black hole Eurodollar shadows, there's still the unwinding going on, the proactive repricing of risk, and a whole bunch of other knock-on and secondary effects that we're now seeing come out in these various figures. So like I said, what I wanted to start with today, really why I want to do a live stream, is because we got this update from the New York Fed, and these are repo fails for the quarter end, which gives us a little bit more insight into conditions about collateral and dealer balance sheets and everything else. So there was a spike in repo fails the week before, which was the second to last week in September, which surged up to around 400 billion. Let's get into the slides here, and you can see what I'm talking about. So repo fails have been rising since August 5th, and I'll come back to that in just a minute. That's really important because we all know what happened in early August. And so they kept on going through the middle part of September, and then we got the last week's data, which showed a 400 billion surge in repo fails, and that's combined to receive as well as to deliver, so both sides of the repo transaction. And you can see that's the most in fails since the end of last year. So something substantial. And then the latest data we got today was the New York Fed confirming that repo fails were basically the same amount on the other side of the quarter. So these 2 weeks straddle the quarter end, and we got 400 billion for each one, which is an enormous surge, particularly compared to the end of the second quarter when they were literally less than half of that rate. So something's going on, and it's not just the quarter end. It's been building up all along. So let's get into the background here. There's a story, as I said, going on in repo fails and collateral overall. So we take a step back and look at the last couple of years. What you see is that repo fails absolutely surged during that volatile year of 2022. We had repo fails that continued to climb until we got to September and October of 2022 when things really started to break down. Remember, we had those Swiss National Bank auctions in dollar auctions in early October 2022. These things are all related to that. And then on the other side of that, as it looked like Europe was going to survive and maybe some of the worst case scenarios with some of the bond yields and bond spreads, whether it be Italian or some of the European spreads, they got better. And repo fails have been basically on a downward trajectory over the last year and a half. Now you see there's a bit of a deviation in the early part of 2023, which was related to, first of all, the Silicon Valley Bank and Signature Bank, the banking crisis of early 2023, but also keep in mind, that was the debt ceiling period too. There's always that bad timing. The Treasury Department always decides, and Congress, really, the administration, all the politicians, they always get these debt ceiling dramas at the worst time. So Treasury was restricting Treasury bill supply during the banking crisis itself, which is why bill yields went plummeting and prices skyrocketed. But by and large, outside of that period in 2023, repo fails have been going lower and lower and lower in pretty steady fashion up until early August of this year. So we had a little bit of an eruption in early August, and obviously we had other indications of things going the wrong way in collateral, which I'll get into a couple of those in just a second. But it's very clearly now, and this is one of the reasons why I want to do the live stream with the updated figure from the New York Fed for the end of September and the early part of October. It shows that this break in trend is continuing. So we had a break in the trend in early August, coincident to all the liquidations across stock markets, and it really isn't about stock markets, the carry trade stuff that went on, all of the financial volatility in early August, that unleashed this break in trend. And now that we see that it's continuing, there are some pretty substantial implications about what we're actually seeing and what's really going on here. I do want to point out that the quarter end rise and fails itself is not necessarily important, because ever since really the latter part of 2023, fails, for reasons I still haven't identified, have now exhibit a quarter end jump. But as you can see from late 2023 into the first couple quarters of 2024, the quarter end rates continue to go down, which is consistent with the repo fail trajectory, that pattern and that trend moving lower since the end of 2022. So it's not necessarily that quarter end fails spiked, but how much they moved up at the quarter end and how that relates to what it tells us about this trend. So the higher rate of quarter end repo fails here at the end of the third quarter, well above the second, well above the first, and consistent with last year at the end of the year, tells us that yes, there is this break in trend is a real thing. It's not just a short run variation. It's actually happening, and it's still ongoing, which is one of the key points I want to make here. So we have this break in trend. That's the underlying background. And so we've seen other indications that, especially in late August into the middle part of September, there was a fair amount of collateral shortage indications suggesting a lot of collateral scarcity, which really shouldn't be the case, because the Treasury Department continues to offer tons of Treasury bills. Now, they did scale back a little bit late in August and early part of September. But when you look at the bill yields, for example, the 4-week bill yield in particular, now, while all the bills were going down in yield, anticipating the Federal Reserve's 50 basis point rate cut, which ended up happening, you can see, especially the 4-week bill, that kind of moved down a lot faster than all of the other ones, much farther than you would expect, given its relationship to other interest rates, especially at the front end. And I'm showing you here SOFR, the 1-month term SOFR, as well as the 3-month term SOFR. And just to be clear, this is we're talking about term SOFR, not term SOFR futures, which are derived to try to price out what term SOFR will be down the road. And to make it even more confusing, term SOFR itself is derived from term SOFR futures. But essentially, term SOFR is supposed to tell us what short-term money markets are like at various terms today, or whatever day we're actually analyzing. And so what normally happens, and you can see this before August, the 4-week Treasury bill is usually well above these term SOFR rates. But through the end of August and the first part of September, the 4-week bill yield went so far and so fast, there were some days that it was actually below one month term SOFR, and it got close to 3-month term SOFR in a couple places, which tells us that there was anticipation of the Federal Reserve's rate cut, which happened in the middle of September, but there was more than that. If it was just the Fed's rate cut, we wouldn't have seen the 4-week Treasury bill yield go down and therefore the price go up as much as it did. There was something else driving the bill yield lower. And of course, that's consistent with everything else that we're talking about here. Whenever we see a substantial scarcity of collateral, you better believe that the 4-week bill is right up the top of the list of what people are buying. So that we see, even in this rate cut period, that there was extra additional demand in the 4-week bill, consistent with everything else. So there's another indication. Swap spreads is another key one, tied into collateral in a lot of different ways. Obviously, you had a big drop in swaps from the middle of June leading up to early August, which told you that the marketplace was changing already, even before we got to the early part of August. Not necessarily about collateral in that period, but more along the lines of financial market participants who were increasingly hedging against dire circumstances. So even before August erupted, the entire financial markets began to shift in that direction already. And then there was a little bit of a pause after August 1st, 2nd, and 5th, when all the liquidations happened. And swap spreads were mostly sideways to slightly higher. And then again, late August into the middle part of September, they started to drop right along the lines of what we're seeing now. And as of the last couple of weeks, this week and last week, the 10-year swap spread is very close to a record negative low. In fact, it hit a record negative for at least the SOFR version of interest rate swaps early in October, and it was very near to setting a record earlier this week. So again, another indication of not just the same type of disruption, but also that it is still ongoing. It hasn't stopped. See the same thing in the 30-year swap spread, which is in many ways a lot more important. Again, same type of pattern, big drop in leading up to August, a little bit of a sideways in the middle part of August, and then another leg lower in swap spreads, indicating more hedging demand, more dealer balance sheet constraints, more concerns about collateral. Those are basically the three big factors and properties that drive swap spreads in either direction. Another indication suggesting that there are collateral implications here. Dealer holdings of U.S. Treasury coupons. We always see those rise whenever either we're heading into a period where you end up seeing a collateral shortage, or we're in the thick of it like we're talking about here. And it's not coincidence that you see a huge spike, which was up to a record high on August 5th. Again, consistent with everything that was going on at that time, including a collateral shortage. And I didn't include it in this presentation here, but I've done this on other YouTube videos. There was an outright and obvious collateral scramble for collateral on the morning of August 5th as everything was melting down. You saw the 4-week Treasury bill yield absolutely plunge during the early morning hours, which is usually when we see the collateral shortage signals. So it ties into everything else, suggesting that there was a collateral angle to everything that happened. And what we're saying here, what we're getting from the data is that collateral was not just limited, or the shortage was not just limited, and the break in trend was not just limited to the early part of August. It continued on into September, and it looks like it's continuing on into October. So the reason why dealers end up holding more Treasury coupons, there's several different reasons, but the primary reasons are, number one, defensive. They want to own more. They want to own outright more U.S. Treasury coupons, anticipating that as collateral difficulties start to strain the system that circulates less and less, it makes it more expensive for collateral to circulate, especially if you get caught where in a shortage situation and you have to replace a fail or cure a fail somewhere along the way. It can get to be pretty expensive. So dealers they will hold more Treasury coupons in their inventories as a defensive measure, anticipating collateral difficulties up ahead. And there are other dealers who will anticipate the same thing, but rather than being a defensive measure, it's more of a proactive step to make a profit. There's an opportunity there, because as collateral gets short on the other side, those who are increasingly desperate to acquire collateral, they're more than willing to pay up to do so. So dealers will hold more Treasury coupons and some bills at particular times in their inventories, anticipating being able to make an additional profit off of a collateral scarcity. If you need collateral and you've got cash and you need the Treasury bond, you will lend that cash to the dealer at a lower and lower rate, depending on how desperate you are to acquire that collateral. So there's opportunity to do so. So we oftentimes see dealers hold more and more collateral as they anticipate these difficulties happening, and then they'll hold those inventories as they come out, as we see indications of it across the marketplace. So we had a huge surge to a record high in dealer holdings of Treasury coupons right there on August 5th. And as you can see here, they stayed high all the way until the middle of September. They dropped off a little bit in the second half of September, but I anticipate when we get the updates for the early part of October, they're going to go back up again. So again, consistent timing there. So we know what happened in early August. Everybody talked about it. It was about the yen carry trade. But the problem is people don't really understand what the yen carry trade is. There's this very wide and broad idea that the yen carry trade is a bunch of hedge funds who borrow in yen to reinvest someplace else. And that's not the real carry trade. The real carry trade is Japanese firms who have access to tons of yen, either through deposits or other interbank means, and nothing to do with that yen. They don't want to invest in Japan, because why would you want to invest in Japan? That seems pretty obvious. And so what they do instead is use the yen that they have, or the access to yen that they have, as collateral to swap into US dollars, and either buy higher yielding US dollar assets, or in many cases use those US dollars that they swap into to then swap into another currency, buy assets over there, which is what a reserve currency is supposed to be. It's a vehicle currency. So the real yen carry trade is the largest Japanese financials who have huge liabilities to fund, and so have a huge demand for higher yielding assets outside of Japan. So they want to swap into US dollars constantly, and they want to swap into US dollars regularly, all the time. They want to continue to do so. But over the last couple of years, what we've seen with the yen carry trade is that as US dollar funding costs have risen, US Treasury rates, for example, have not risen as much. That's the inverted yield curve, which has pressured these yen carry traders because they would prefer to own and hold only the safest instruments. I mean, they're already on the hook for a lot of other stuff anyway. So they want to generate as much return as they possibly can in the safest way possible. But the conditions over the last couple of years, and we saw this to an extent in 2018, 2019 too, forced them to reach for yield. Because US Treasuries were not really covering the cost that they had to swap into US dollars, they started to buy other things. Again, this goes back to 2018 and 2019, where they would buy, for example, tons of leveraged loans, especially leveraged loans that were packaged into collateralized loan obligations or CLOs. And in the initial part of that trend, they would own only the best high-quality AAA rated senior tranches of these CLOs because they didn't want to take on a whole bunch of risk. And at the time, they didn't need to because by going into CLOs, they were getting an additional spread over and above US Treasuries anyway. So they could more safely and dependably cover their US dollar funding costs. Well, that all changed over the last couple of years, as I said. Instead of being able to cover and reach for yield in just AAA rated CLOs, over the last several years, as some of those spreads have declined, Japanese firms, they've even said so, they started to buy riskier and riskier portions of CLOs and justifying it in a couple different ways. But one of the ways in which they justified it was that the US economy was strong and resilient. Jay Powell said so. So there's no risk in buying, say, a AA rated CLO or part of a CLO or a single A rated, or God forbid, and who knows what, if they've gone even further down the risk curve and really into some of the junkier parts of what isn't already a junk corporate structure. Because remember, these CLOs are made up of leveraged loans and other lower quality debt pieces of debt. So all of that came to a head in July and August. Even before we got to August, this carry trade, Japanese financials who are already swapped into US dollars and own higher and higher risk CLOs and similar types of products, credit products, on the understanding that the U.S. economy is generally fine, and therefore there was okay to take some additional risk in CLOs. Around the middle of July, they realized that assumption in particular, the idea that the U.S. economy was fine, may actually be faulty. And so that's where the carry trade started to unwind. Because they've known all along, the Bank of Japan has warned them for years. If the U.S. encounters a recession, then all bets are off where it comes to CLOs. They appear to be liquid instruments, at least the ones that trade. But after our experience in the first financial crisis, as well as in the 2014, 15, and 16 leverage loan and CLO debacle back then, the bust that happened there, what appears to be liquid one day is illiquid the next day. And so the Japanese firms know that that's macroeconomic risk to these CLOs extends into the liquidity realm as well. So as they began to see more and more signs around June and July, remember swap spreads falling lower in June, that signaled that the tide was shifting. And the Japanese in particular, especially on July 11th, which is when the US CPI came out for the month of June, it wasn't about the Fed's reaction to it. It's about the fact that the CPI, as I said at the time, the whole marching band of red flags, what it suggested was that there was more weakness in the real economy in the United States than was being anticipated by especially the Federal Reserve, Jay Powell, and really the public. And as we'll see in just a moment, also the investing public. So Japanese carry traders got more and more nervous from the middle of July about being exposed to high risk, low quality CLOs and began to reverse the carry trade then. And of course, we see that here in the rising yen against the US dollar. It was not about the Bank of Japan's rate hikes. It was about recession risk driving the carry trade unwind until something actually broke that weekend, that first week in August, really the 1st and 2nd and then the 5th, when we had all of the labor market data. Remember, there was JOLTS that came out, and then there's jobless claims the next day, and then finally the payroll report and the unemployment rate on, I believe it was August 2nd. So what that confirmed, or started to really confirm, was that recession risk was indeed real in the United States, and therefore everybody in Japan, I'm being a little bit hyperbolic here, but enough financial participants in the yen carry trade from the Japanese perspective realized they didn't want to sit there and just watch the CLO market fall apart. So instead, they ran for the exits, creating the conditions that led to these liquidations and chaos. So that's the story of the yen carry trade up until early August. And it seems like, at least from the mainstream perspective, that the yen carry trade kind of just, it hit another equilibrium, and then just everything was fine thereafter. I mean, stocks are back high again. The US economy seems fine. So there is no more yen carry trade to worry about. In fact, you see mainstream media reports about how their version of the yen carry trade has been put back on by hedge funds. But as you can see here, just from the yen's exchange value to the US dollar, it continued to go higher. The yen did against the US dollar, suggesting more carry trade unwinding, not just early August, but also the middle of August and into September. Again, very much consistent with the collateral indications that we're getting in repo fails, as well as those other things like swap spreads and others beyond it. So essentially, we see the carry trade coincident to rising collateral difficulties, and all of it tied to U.S. recession risks. And I know there's lots of questions about how does the carry trade unwind lead to rising repo fails in U.S. treasuries, and we probably need a whole webinar on connecting those dots. But what I will say is that, just very briefly, because U.S. money dealers are in the center of everything, and I mean everything, whether it be derivatives, currencies, collateral, the entire system. Imagine that you're a money dealer and you manage not just cash flows coming in and out, you're also matching collateral flows coming in and out. And some of your most sophisticated customers, these Japanese financial firms that are engaged in the yen carry trade, come to you and say, I don't like what's going on in the US. I think there's a recession coming here. I want to liquidate my CLOs. As a dealer with that inside information, especially as it is coming from a dependable source, you're going to use that information and become more and more risk averse in your own dealer activities. So just from an informational standpoint, the fact that so many Japanese firms and other firms besides Japan started liquidating their CLOs on US recession risk, you better believe that changed and altered the behavior of money dealers whose central function is to circulate and redistribute cash and collateral. So there's just a direct informational connection between what Japanese carry traders were doing and how dealers responded to that information. And there's other ways in which this happens, but just wanted to throw that out there. And it's like you said, it wasn't the Bank of Japan that triggered the liquidations and the financial volatility in early August. This was all about U.S. recession risk. It certainly was, with the exposure to leverage loans and CLOs from the Japanese yen carry traders. So we know that's the background behind early August. And again, this is something that the Bank of Japan had warned about for years. And for the longest time, the Japanese firms just downplayed that risk or ignored it or completely dismissed it. In many cases, they did so irrationally, simply because they had to. They had no other choice, especially as US dollar funding costs rose in 2022 and 2023. And it looked like Jay Powell said, higher for longer. They had to deal some way with these negative carry prospects. They convinced themselves and rationalized that there was very low risk into buying these CLOs, even though the Bank of Japan, regulators, authorities, and I'm sure their internal risk committees and mechanisms told them buying CLOs entails a great deal of risk, in particular with a U.S. recession scenario. Because the U.S. recession is not just about U.S. recession either. It also has global implications. But specifically, we've seen CLO performance, we've seen CDO performance in other forms back in the original crisis, and they do not perform well in a U.S. recession scenario. And in reality, these latest versions of CLOs have never actually been tested. So even more reason for Japanese firms, when confronting the idea of a potential U.S. recession, to say, screw it. The recession risk appears to be real. I'm going to get out of these positions because I don't want to find out. I don't want to be the guinea pig in this test case. So that's part of this risk perception. And the other part of it is, too, the Japanese firms who were engaged in this carry trading, as they bought more and more CLOs, that compressed spreads more and more, and it led to the same type of bubble and circular logic that you find in every bubble situation. As spreads continue to go lower because Japanese firms don't have any other alternatives but to reach full yield, it looks like the market is saying that risks are decreasing as well as spreads are. So it sounds like the market in narrowing spreads is agreeing with Jay Powell. The market narrow spreads mean, yes, absolutely soft landing. And so that convinced a lot of Japanese firms and a lot of everyone around the credit markets that as spreads went lower, that wasn't because of reach for yield. That was because of the fundamentals in the U.S. economy, ignoring all the other signals we got from, say, inverted yield curves and everything else. So it created an increasing proportion and increasing allocation to these types of assets at the worst possible time. So you've got more and more people piling into this at the worst possible time, right when everything that was assumed to be true that justified taking on this risk was starting to look to be untrue. Again, U.S. recession risk. And as I said in the introduction, or at least I put on the screen there as one of the bullet points, you do not have to take my word for any of this. In fact, Bloomberg just this week on October 8th provided the most damning piece of direct evidence you will probably ever find. They put together an article that actually quoted a key player. I think it was the CFO or CEO of Mizuho, which is a major carry trader out there. And he said point blank, we are afraid of U.S. recession risk. Not only are we afraid of U.S. recession risk, we are indeed taking proactive steps in exactly the manner that I just described to you. They are buying more U.S. treasuries. And the reason they're buying more U.S. treasuries as safety and liquidity, at the same time, they are unwinding the carry trade by selling their CLOs. This isn't early August. This is well into September. And again, according to all the data that we're getting, including repo fails at the end of the quarter end, if not Mizuho, then other Japanese carry traders are continuing to do the same thing into October. This wasn't just a one-off that happened in August. It was a one-off that appeared to happen only in August, so long as it was back, so long as it became public out of the shadows. But once that disorder died down, the carry traders realized that they needed to be more careful in how they exited their positions. So they're not all running for the exits over the same time. But you got to believe, and take their word for it here, that they are indeed still unwinding. And the key that ties all of these things together. So we've got the yen carry trade unwinding and reversing. We've got collateral difficulties that show up. We've got that showing up in repo fails. The thing that unites all of these is the U.S. recession risk. So the Japanese firms, those that are not actually outright stating it to Bloomberg, are unwinding the carry trade because they don't believe the September payroll is actually representative of the current macroeconomic shape, or if it is, it won't be for very long. They still believe that U.S. recession risk is way too high to do nothing. And one reason why is because they know what happens, or at least they suspect and reasonably suspect what happens if the U.S. recession does further materialize. What will happen in these more risky, seemingly liquid parts of the financial system that suddenly become illiquid? And in anticipation of all of that, we're getting already these signs of fragility. That's what collateral scarcity is, to the point that, and to the extent that repo fails have broken a 1.5-year trend where they continue to go lower up until early August, suggesting just how serious it is and how much potential fragility there would be, more fragility than we saw in early August, should things continue to go wrong in this direction. So basically, to sum up everything here, I know this is a lot, and it's all tied together, and it's not necessarily very clear how these things tie together, but latest repo fails we got from the New York Fed today confirmed that the trend change in repo fails is ongoing. We got the quarter end surge to 400 billion, and they got 400 billion more on the other side of the quarter as well. So the quarter ends are rising as well as into the quarter end. So that suggests already, because it's repo fails, that there's possible trouble brewing in collateral conditions, which we got any number of corroborations and points of corroboration, whether it be swap spreads, even term SOFR itself, 4-week treasury bill rate, dealers hoarding more and more coupons, all of that stuff suggesting, this is, And the timing is even more compelling than everything else. So there's collateral scarcity that's brewing, despite the fact that the Treasury is still offering a ridiculous amount of Treasury bills every week. The yen carry trade is a big part of all of this, not just in terms of the Japanese weight and proportion in the global redistribution of money and credit throughout the system, but also because the yen carry trade and this version of it and this particular tactic of it is highly susceptible to U.S. macro. That's what really ties all of this together. And again, you don't have to take my word for it. This is still happening. Just listen to the guy from Mizuho. He said, yeah, we're unwinding the carry trade. We're getting out of our risky positions because we don't believe the soft landing is as guaranteed or even a high degree of probability as everybody else. And if they're doing that, you better believe that there are a whole bunch of others who are doing the same thing, which is what we see in all of this data, whether it be repo fails and everything else. So repo fails confirming the trend change, trouble brewing in collateral that is tied to the yen carry trade, which is also tied to U.S. recession risk that didn't go away with the last payroll report. So we've got macroeconomic risks that are perceived much higher than the mainstream does, certainly higher than latest from Federal Reserve officials and central bankers, but also, maybe more importantly, we're seeing that there is still a risk of fragility in the same way that we saw in early August. So like I said, there's a story brewing here in collateral, and it was just confirmed a little bit earlier today with what we saw at the quarter end. And this is definitely something we need to keep an eye on because it is corroborated and consistent across monetary indications as well as the other financial markets. So that's what I wanted to present to everybody today. Thank you very much for joining the live stream. Really appreciate it. And I think we're going to do some of these more frequently because I've got a hunch we're going to need to.